Crude oil is taking a breather from its big run. Let's trade it, talk about the chart with Mr. Bob Iaccino joining us from Path Trading Partners. Bob, so we did kind of flirt with that 95, but couldn't quite hang out there for too long. Anything to make of that?
Well, crude oil is taking a pause, and I'm taking a pause in my crude oil position. I've closed the entire thing out, but honestly, I'm going to be looking for a place to get back in. Now, I'm still not in that $107 camp, not in the short term. But the beautiful thing about being an analyst at Goldman versus what I have to do for a living is you don't have to be right next week, next month. You could be right next year, and the Goldman target will have been seen as right. From my perspective, this feels like one of those times where, where you have like your star player in the fourth quarter in a basketball game, and you rest him or her for the first sort of 7 or 8 minutes of the fourth quarter, because I think we're in the fourth quarter of this rally. And my view is that the new range is likely to be between, say, 87 and 102. And those 102, that 100 to 102 area, those are going to be spikes that get rejected simply because we're going into a very slow demand season. We've got a situation where supply is definitely beneath demand. Demand has outstripped supply, but we still have to get through all this crude oil that's coming on the market in September. The U.S. is likely to hit or tie their November 2019 record of about 13 million barrels. We still have the production cuts, but some of the other countries in the OPEC plus sort of cartel are overproducing, while Saudi Arabia and Russia are underproducing. So that's kind of even, and demand is likely to drop off. And lastly, we're seeing global economic slowing, maybe not recession today, but I still believe one is coming, and we're seeing that slowing in some of the data already.
So there's a limit to how far this thing can run, or is it more that there's risk of downside? It sounds like if you're trying to get back in, you still view the risk of downside as being less, or perhaps worth taking on, a risk worth taking on?
Yeah, there's levels to the downside, in my opinion, where you're going to be able to get in and again ride these pops to the upper end of what is likely to be the new range. I've mentioned this before. Crude oil has a specific characteristic, and I guess every market has the same characteristic, but it's really evident in crude oil charts. Crude oil goes sideways, sometimes with a slight upward bias, sometimes with a slight downward bias. And it goes sideways because supply and demand are pretty much balanced at whatever price range that is. So if we've got a lower level of crude oil being produced and sold, then there's some temporary demand destruction, and we settle into a higher price range. The other way around applies as well. When we were in that range from, say, 68 to about 80, that was a lower level demand situation with maybe a little bit more supply to satisfy it. So all we're going to do is get into another one of those oil market equilibriums, in my view. And if we can't get more supply on the market by the time the summer drive-in season comes around, then I think we'll get 120. But in the short term, short to medium, whatever you want to call the next month and a half or so, I see us kind of being capped out. Maybe we get spikes up to 100, but they're not spikes that I'd buy.
All right. So far, so good. Been on top of it as the trade that you got out of. I know you mentioned you were looking for the move above 90 towards 95 to take that profit. So now we wait to see if the range develops. Thanks, Bob. Appreciate it.
Good to see you again, OJ.
All right. Have a good one.